Good afternoon, class. So today we will be looking at essay question 1 from your market structure tutorial. Okay, so this EQ1 here is a question as follow. Alright, for question A, explain the advantages that a retail organization such as Walmart might derive from its large size. Okay, question B is on discuss whether monopolies are in consumer interest. Okay, so let us look at question A first. All right, let's do our basic question analysis. So looking at our question analysis, we identify our three C's. All right, so first C, command word. Okay, you can see that command word clearly here is explain. So you are asked to explain, all right, the advantages, all right, that a retail organization such as Walmart. Okay, what is Walmart? All right, Walmart is actually a supermarket in US. All right, something like our NTUC FairPrice in Singapore's context. All right, so I think it also suggests that it's a large firm here. All right, so this is basically what we have derived based on the question. Okay, so for part A, it's basically very simple. All right, you are asked to explain advantages of a large firm. All right, and I think if you recall, okay, before we go on to question analysis, let us look at some background information. Okay, so down here what we have, okay, is a table of the market share, okay, in US in the food retail sector. All right, you can see Walmart takes up a whole 25%. That's all about 1/4 of the market, and that's quite a significant amount lah. Okay, and I think further information about Walmart and its market size. Okay, Walmart is actually you can see market share of major companies in the US retail industry in 2015. Okay, a significant 10.8%. Alright, so it's hold quite a significant stronghold on the US retail industry. Okay, this aside, I think just something for you to expand your knowledge about, okay, not just in Singapore's context, but somewhere further in US. Okay, so coming back to our question. For question A, it's a very simple question. We have done this before. All right, advantages of a large firm. All right, so you are just asked advantages of large firm. You know advantages of large firm, there's cost advantages. There is revenue advantages. All right, when we talk about cost advantages, we are talking about your economies of scale. So you know that you will need to talk about this. You need to define what economies of scale is. All right, and out of the following, you choose two. All right, choose two to elaborate and explain. All right, and then that's for cost advantages. For revenue advantages, I think you are aware about how revenue advantages, larger market share would increase demand for the good. All right, and the fact that Walmart is large, is actually able to offer a wider range of products, which again allows it to gain revenue advantages because it is able to further expand its market share. All right, so I think for question A is very simple. Just elaboration on 2 points here and these 2 points here. All right, so I think it's fairly easy. All right, so without further ado, let us move on to question B now. Okay, if we look at question B, discuss whether monopolies, monopolies, something that you have learned very recently, are they in consumers' interests? All right, I think we had a very similar question previously in one of our case study where we look at the different economic agent. All right, and this time around, instead of looking at firms, rival firms, consumer, or even your society, we are just focusing on consumer. All right, so be mindful to talk about consumer interest. What is consumer concern about? Concern about pricing. All right, concern about your consumer surplus. correct? About choice, right? About innovation. These are several areas which I think you can see, all right, that whether these are areas that consumers are interested in. All right. So for this question, very clear cut question here is discussed. So I need to go two-sided. Content word, monopolies. Okay. Consumer interest. Are they in consumer interest? Context here, it has to be monopolies lah. All right. Before I move on, do remember when we talk about monopolies here. Okay, we are talking about your regular monopolies. There is also one class of monopolies which are what we call natural monopoly. Okay, and if you remember from the lecture note what natural monopolies are, they are monopolies that actually is able to spread their long run average cost across a very large output. Okay, so they have very so their average cost curve looks something like this. This is cost, revenue, price. Okay, and then this is your quantity. So their MC curve is like this and their AC curve is like this. Alright, it's unlike your U-shaped MC or your AC curve. Alright, so please be mindful of this. Okay, so when we talk about this context, you need to define, of course, what a monopoly is lah. Alright, and I think in lecture you have learned about the characteristic of monopolies, the behavior, alright, which is basically defined from its characteristic, and based on its behavior, okay, how it actually perform. Alright, so this question here is on whether is it in consumer interest. So it's very much linked to this performance aspect. So when we are asked to look at the performance aspect, you need to look at areas such as efficiency, equity and choice, and welfare of consumer, as well as societal welfare. Alright, let me look at efficiency first. Alright, so when we talk about, okay, so to address this question, alright, my thesis here, basically they are in consumers' interest. Alright, so to say that it is in consumer interest, we need to find supporting points as to how monopolies are in consumer interest. Alright, my antithesis will be the converse of that. Basically, monopolies are not in consumers' interest. Okay, so thesis, monopolies are in consumer interest. Antithesis, monopolies are not in consumer interest. Okay, so let us have a look at how we argue, all right, for our thesis. So to argue for our thesis, we will talk about how monopolies here, they are in consumer interest. All right, so if we look at allocative efficiency, all right, I think you do recall that this is actually our antithesis. All right, because the price that your monopoly, okay, your regular monopoly charge, this is PCR, price cost revenue quantity. This is your AR curve, equal demand. This is your MR curve. This is your MC. This is Q. This is P. You can see clearly that allocative efficiency is not achieved lah. So what we are saying here is compared to a perfect competitive firm, monopolies, okay, actually incur a deadweight loss. Okay, deadweight loss. So this one has implication on societal welfare. And because of this, it may not be consumers' interest. Alright, because consumers, they are paying much more than what they would have paid if they were in perfect competitive. This is PPC, this is QPC, and they have much higher output lah. Alright, Okay, so this is antithesis. Okay, so this one you something that you will elaborate in your antithesis. When we talk about productive efficiency, the fact that they are producing along their long run average cost curve. So from firms' perspective, they are productive efficient. But from societal's perspective, it is not productive efficient. Alright, so this one if you want you can bring in antithesis. Alright, but I will not necessarily bring this in. Alright. What I'll focus on is on this part here. For my thesis, I'll talk about dynamic efficiency. Alright, because when we talk about monopoly, they have the ability to make long run profits, supernormal profits to be exact. Okay, and because of this fact that they are able to make supernormal profits, they would have incentive to do R&D, to innovate, so they are dynamic efficient. Okay, so because of this, it is linked to your choice. All right, so because of dynamic efficiency, firms actually are able to provide choices for your consumers. All right, so that's something that will be in my thesis. All right, this other thing that I'll have my thesis is basically very much linked to what we have in our part A, where we talk about Walmart. All right, Walmart is not a monopoly lah. All right, but monopolies here generally they are large, and especially if we are looking at natural monopolies. Natural monopolies, okay, we talk about natural monopolies because of its ability to spread its long run average cost across a large output. It is actually in consumer interest. All right, because in this particular case, all right, it is actually able to spread the cost across a large output, enjoying what we call economies of scale. And when we assume these monopolies pass on this economies of scale, this cost savings that they enjoy to your consumers in terms of lower prices, then definitely it's something that is very much beneficial on the consumer's aspect. All right, and then the X inefficiency. All right, that they may be complacent because of the if we assume lack of competition in this particular industry, and they end up not innovating or producing something that is more productive and all. All right, so let me try to recap what we are going to have in our thesis and our antithesis. So in my thesis, I argue about, okay, in the context of natural monopoly, okay, the ability to make EOS, okay, because of its large size here, all right, cost savings that they enjoy can be passed on to consumers, lower prices. So this is definitely advantageous. All right, the other advantage is of course this part here, the dynamic efficiency. But there's a caveat. Okay, they only will be they are likely to be more innovative and research and engage in more research and development if we assume that they are experiencing contest, so contestable markets lah. All right, so we assume in this context here, if it is a contestable market and there's this constant threat that new firms may enter, then your monopolies will have incentive and will engage in dynamic efficiency. All right, so this is for our thesis. So you have 2 points here. For our antithesis, all right, another 2 points. First of which will be this part here about allocative inefficiency. Okay, because P does not equal MC. All right, so you will see a deadweight loss incurred. All right, and consumers at the end of the day, all right, being charged a higher price than what they would have been charged if they were in PC. Alright, and the second point here is this X inefficiency. Alright, remember just now when we talk about dynamic efficiency, we argue that if the markets here were contestable here means that if there's this threat of another firm entering, alright, then your monopolies logically will want to engage in R&D innovation to try to differentiate themselves, to stay relevant and stay competitive lah. But okay, many a times because of the nature of this monopolies market, all right, some of this monopoly they may be complacent, and as a result they don't find cost saving methods to produce and all, so end up resulting in what we call X inefficiency. All right, so you can bring this part in. Alternatively, you could talk about how, all right, choice. Okay, earlier we mentioned that if it's contestable, your monopoly will engage R&D innovation, produce new variety of products. Okay, but in this case here, if we argue otherwise, complacency and all sets in, then choice here will be what we call an antithesis. They may not have very much choice here. Okay, so at the end of the day, two theses, two antitheses, all right, based on what we have analyzed here. Okay, so now today we'll be focusing further on this part on evaluation. All right, so remember in our thesis we talk about how monopolies are in consumer interest. So the 2 points here that we have, consumer interest, we talk about EOS, right? We talk about your natural monopoly. The other one that we had and which we talked about was this part about dynamic efficiency. In our antithesis, remember, we talked about how it's not in consumer interest. We talk about allocative inefficiency. That P does not equal MC. P is actually more than MC. So incurs deadweight loss. Correct? And then not just that, but your X inefficiency, complacency sets in, and it affecting your choice. If, so this part here, remember we assume contestable. This one here, we assume they are complacent. Okay? Remember we put in assumptions to fit our thesis and antithesis. Okay? So based on that, we have our thesis, we have our antithesis here. Right now, let us look at our evaluation. Alright, so evaluating whether monopolies are in consumer interest. Okay, so we presented both sides, thesis and our antithesis. Right now, we want to go one step further, show a higher level of thinking and coordination of your mind to argue this point whether monopolies are in consumer interest or not. Okay, so you ask yourself this question: are they in consumer interest? At the end of the day, we assume if it's natural monopoly, it's in consumer interest because of ability to make EOS and it presenting to consumers in terms of lower prices, right? So at the end of the day, whether monopolies are in consumer interest, this is a very generic question. So we want to highlight our higher level of thinking by telling or by responding by saying that at the end of the day, whether they are in consumers' interest depends on the context, the industry. Remember our CAS? Right? It depends on the industry. So if the industry was in an industry that is a natural monopoly like your utilities, public utilities, electrical or water supplies, okay, then very much these monopolies are in consumer interest because of the ability to read EOS. In the long run, your average cost is actually spread across a large output. So these are what makes it very positive towards consumer interest because this presents cost savings. All right, so at the end of the day, this is something that we want to highlight, and that's why we want to present this in our evaluation. Okay, remember C, so that's context. In our A, we are talking about assumptions. So remember when we talk about thesis, antithesis, we assume about contestability. We assume about complacency. So at the end of the day, what kind of assumption are we making? If we assume that it's contestable market here that we are referring to, which is in this case here, as long as there's some level of competition, some threat of competition in this particular market, then monopolies would generally be in consumers' interest. So that is this evaluation part that we want to bring in. Okay. All right. And then last but not least, our suggestion. Okay. So this suggestion can be you suggest something or you can suggest something that is actually in place already. All right. And I think if you go back and read through some of the articles, they talk about Microsoft, monopoly, okay, lawsuit and all this kind of thing, you would be aware about how countries, governments these days, they have what we call antitrust regulations lah. All right, so basically what these antitrust regulations do is basically they go hard against monopolies that try to exploit consumers. Okay, so with these antitrust regulations in place, I think very much if there are monopolies, these monopolies that are existing, all right, are generally meant for consumers' interest lah. So most of the time we generally see natural monopolies existing more than any other type of regular monopolies. Okay, because you look at how Microsoft has been forced to break down. Okay, Google has also been actively taking measures to try to break themselves down. All right, so I think that's the end of our session today. So if you have any further questions, do let me know. All right, and see you around in school.